This is the Chicago Board of Trade in session. Today, the global derivatives market processes trillions of dollars in trade value every year, and a significant portion of that volume relies on a specific type of agreement, the option. At its most basic level, an option is a contract that grants a person the right, but not the obligation, to buy or sell an asset at a later date, under a specific set of conditions. Think of a standard forward contract as a fixed track. You agree to buy a commodity, and when the day comes, you must buy it. But an option is a contingent claim. It creates a branching path where, on the expiration date, the buyer can choose to complete the trade or simply walk away. By decoupling the right to buy from the obligation to buy, this mechanism allows traders to isolate and trade risk itself, effectively turning price uncertainty into its own measurable commodity. The structure of this trade appears as early as ancient Greece. The philosopher Thales of Miletus, tired of being mocked for his poverty, used his knowledge of meteorology to predict a massive bumper crop of olives for the following summer. Thales didn't have the capital to buy the orchards. Instead, early in the year, he paid a small amount of earnest money to the owners of all the olive presses in the region, securing the exclusive right to use them during the harvest. When the bumper crop materialized, demand for presses spiked. Thales exercised his right to control the equipment and rented the presses out to farmers at any rate he chose to fix, making a considerable fortune. Aristotle later recorded the event, but he viewed it through a narrow lens. He framed it as a story about a philosopher proving he could get rich through a monopoly, rather than as a demonstration of a liquid financial market. Thales proved the concept of the option, but his version had a system bug. He still had to take physical control of heavy wooden olive presses. For options to scale, the contract had to be separated from physical property. The next stage of development happened in medieval ports and fairs. Urban merchants faced extreme risk when buying goods that were still at sea. Time separated the price agreement from the delivery, and cargo often arrived in a different state than promised. To manage this, traders developed the buyer's refusal. This convention allowed a purchaser to refuse delivery of goods if the actual cargo didn't match the original sample they were shown at the time of the bargain. These disputes, recorded in notarial protests going back to antiquity, began to formalize the legal rights that define the modern option. If the delivery wasn't satisfactory, the merchant had the right to walk away. The option was born not as an abstract financial theory, but as a practical patch to solve the problem of rotten or inferior goods in physical trade. In the 16th century, the Antwerp Exchange became the first hub where financial contracts separated from physical goods. Speculators traded to-arrive contracts for grain or whale oil, not for the actual goods, but simply betting on future prices. This environment standardized the Stelligeld, or premium. A buyer made a contract for future delivery at a fixed price, but with the condition that they could withdraw from the deal after a few months by paying a set fee to the vendor. By turning the merchant's right of refusal into a tradable paper instrument with an upfront fee, Antwerp transformed a defensive measure into a tradable security. After Antwerp collapsed in 1585, the center of innovation moved to Amsterdam. It was here that options shifted from physical commodities like herring and salt to abstract joint stock shares of the Dutch East India Company. While speculators were famously betting on Dutch tulips, agricultural options were limited by a lack of standardization. Every bulb was different, but shares were uniform and existing only on paper, making them a much more efficient vehicle for complex bets. To handle the volume, the Dutch introduced the rencontre, a quarterly settlement process. Instead of delivering physical stock certificates to settle a bet, brokers gathered to calculate the price fluctuations and simply paid each other the net cash difference. Since the underlying stocks rarely had to change hands, even people with moderate wealth could participate. They used borrowed capital to pay their premiums, effectively gambling on the margin of share prices. The rencontre was a critical engineering patch because it allowed a massive volume of transactions to clear without the actual value of the stocks ever needing to be paid in full. By the 18th century, these practices had spread to the coffee houses of London's Exchange Alley. The market was now filled with stock jobbers, using options and time bargains to manipulate share prices for profit. Public outrage followed the disastrous South Sea bubble of 1720, depicted in this contemporary engraving. In response, Parliament passed Barnard's Act in 1733, an attempt to outlaw the entire practice of stock jobbing. Barnard's Act declared all option premiums and all difference settlements null and void. The law was designed to stop what it called the infamous practice of gambling on stock values. But the law didn't stop the trade, it only removed legal protection for it. This meant brokers could no longer rely on the courts to enforce their deals, forcing them to find a new way to ensure trust. Because brokers were now personally liable for defaults, they were forced to organize. This defensive alliance of brokers, built to self-regulate without legal backing, was the direct catalyst for the formalization of the London Stock Exchange. Those 18th century handshake protections have evolved into the hyper-standardized clearinghouses of today, which now manage the defaults and settlements for the entire global derivatives market. The journey of the option reflects a series of practical solutions, from securing ancient olive presses to managing medieval grain shipments and Dutch share ledgers. The modern option is the result of 2,000 years of humanity patching the bugs of risk and trust in pursuit of trading the future.